So next speaker is Adam Butler from Avamore Capital, maybe a lender you haven't heard of, but believe me, they're a lender that is proven to be very, very useful in the marketplace. They really are. We know Adam from his previous employment. He was our loan manager at Hampshire Trust Bank, where we're quite a large provider of business and have been for some years. And he then moved over to Avamore, I think it was beginning of last year. Was it beginning of last year?
Yeah.
Last year. Sort of lose track after what's happened over the last year. So you should have received today from us this morning, I've sent this to everybody this morning, is the product overview for Avamore, along with all the other documentation we've sent over. If you haven't got it, check your spam, because they have all, by the look of things, I've not had any like bounce on me, so just check your spam if you're not, but that's the one you're looking for. Okay, a little bit about Adam first of all. He works for Avamore as a relationship manager, previously at Hampshire Trust Bank as a lending manager for approximately, I can't see what that says actually, let's say 16 months, because my camera bit's over it. Previously to that, he was a BDM at first for bridging and also a BDM for Vida Home Loans for 2 years. Started off in the finance industry as a mortgage broker, mainly in the residential and buy-to-let sector, and spent several years working for brokers such as Countrywide and Mortgage Advice Bureau. And here's his interesting fact. I was going to contact Adam to say, did you want to leave this up, seeing what's happened at the start, but seeing as what happened last night, hey-ho. Interesting fact, Adam played against Christian Eriksen, the former Tottenham and current Inter Milan midfielder, obviously the guy that suffered cardiac arrest in the first game. Excuse me for laughing, because it's not a laughing matter. In the European Youth Tournament in Denmark, you can say to know who actually won that battle. Yeah, probably wouldn't be Christian Eriksen, I presume. I presume it was. Is that correct?
Absolutely, yeah.
Yeah, fine, okay. I think that's the last bit from me. So Adam, it's over to you. I'll see you in about 20 minutes.
No, thanks, Tony. Again, appreciate you having us back on. As I said, it's run really well. So, I think you mentioned, obviously, some people may not know Avamore. So, I always like to start with a bit of an overview of us, who we are, the background of where we come from, where we are now, and obviously cover off our products that you've obviously already received as well. So, bit of a background. Avamore was started in late 2015, so nearly 6 years old now. Started off with 4 key principles for a multitude of backgrounds. I think that's important to note, that we are not a lender who was built by other lenders. You know, people who've come from other lenders rehashing old ideas. They come from within the property sector, but not lending. So I think there's a fresh approach in how they review deals, how they look at things, how they look to lend money. And that's probably testament to the position we put ourselves in, certainly last year, being one of the few lenders to still be actively lending last year, growing the team. As you can see there, you know, we're up to 23 now. When I joined April last year, we were 14. I think we've actually got 2 more joining in the next couple of weeks. And I think probably by end of Q3, we'll be up to about 28. So we are seeing huge growth within the company. As I say, I think that's testament to the position that the guys have put themselves in previous years. The loan book now currently is actually just creeped over the 300 million mark since I typed this up. So a very healthy loan book we've had at the moment. And as I say, currently sort of around 130 million pounds worth of assets currently under management. Obviously, with us, vast majority of business we do is shorter term, so that loan book does turn over quite quickly. And largest deal to date is 13.1 million that we've done so far, which was a part completed development, which I'll cover off in more detail later on. For us, there's 4 key products that we lend on: bridging, development, whether that be ground up or part completed, and then any refurb or conversion, right the way through from light refurbishment right the way through to heavy refurbishment. And I think it's important to note, and you'll see on some stats I'll show you later on, is that we are not a development lender who dabbles in bridging or vice versa. You will see a very consistent, even split across all our 4 key products. And I think that's important to know because, I know what it's like for brokers. It's very difficult to keep up with the market. There's lots of new lenders coming on board, and it's about what do they do, what's their specialty, and quite often you can be pigeonholed into one rather than all. And certainly I would say that, we are expertise across all 4 of our key products. But at the same reason, that's why we don't delve into other things. We want to be the experts in what we can do, the masters of some, rather than trying to do everything. And I think, as I say, it's going to be hopefully a really good time to present to yourselves, because we've done some massive changes to our products offering across all 4 products. So we'll cover that off when we get to the product page. Just a bit on funding lines. Currently 2 institutional funding lines, albeit we are expecting to have a 3rd join in the next month. a large institutional funding line that you, without being able to name, you will know, fund a large part of the specialist market. And again, we have a number of funding lines constantly approaching us because of the way we lend money. They see that we do a lot of work internally. Our loan book is very safe compared to others. So, we're constantly looking at building the funding lines, but I think we have two very strong ones that actually the offers we get given are not as good. So actually, I think we're in a really strong position from that point of view. But we also do work with a number of more sort of private funds. A couple of our principals do have their own funds as well. So I think we can cover everything from what you would call the more vanilla, albeit vanilla in the specialist market, right the way through to the weird and wonderful stuff. And I think that's good. We've seen obviously the difficulties for lenders who rely on just one funding line last year. So I think having that varied not only gives you the security, but it gives you that variety of what you can actually look at in terms of the types of deals. Just a bit of an overview of the last sort of 12 months in terms of our figures and parameters. I won't run through all of these, but I think there's a couple of points in there that I really wanted to bring up. And the first one I always talk about is our formal terms to completion at 92%, which is a million miles above the industry average. And we work in a slightly different way in how our process works. So you would start with an indicative offer, a decision in principle, whatever certain lenders call it, which is effectively, figures work, estimate where it's based is okay. You will then get a list of documents, normally 5 to 6 items that we need to go to formal offer, which is go straight into credit committee. We can do that the same day, and then you get a credit backed formal offer, and we complete on 92% of those, and that's without having a valuation done, without having a QS go out, any of the legal started. And that just shows you the level of, I think, 2 points, the due diligence that the guys do at an initial stage. And also, more importantly for you as the brokers, the level of honesty we do. And I quite often say we're probably too honest for our own detriment sometimes within this market, where you may have other lenders who dangle the carrot a little bit and wait for valuations and things like that. If we don't think a figure is right, we will bring it up at that point, whether that's the build costs, the GDVs, and work with your clients to actually honestly approach it and say, actually, we think this should be, build costs should be raised, or actually let's work off a slightly lower GDV. And then you've got, we would always rather work our way up and improve the offer throughout the process rather than give you something that's top end and actually, everyone knows it is actually likely to reduce throughout the term. So I think, as I say, that 92% is a huge testament to the work that the credit analysts do, the underwriters do at an initial stage. And as I say, is well above the industry average, probably in the 60s, 70s, to be honest with you. Average completion time of 4 weeks. Now, you may think that's not necessarily that quick for a bridge, but obviously that is an average across, very basic bridging, right the way through heavy refurbishments, conversions, ground up developments, part completed stalled developments, which can sometimes be quite tricky. So I think when you start looking at an average turnaround time, including development finance, I think that's a very good turnaround time. And then the final point really is, as I mentioned before, is if you look at the bottom 4 of 5 there, you can see the split across our 4 products. So 68 bridging loans, 61 on the refurb conversion product, 22 on the finish and exit, and ground up at 41. So, albeit yes, ground up finish and exit is lower in numbers, but actually when you look at the volume, it's very similar. And that tends to be that stalled developments, part completed developments, they tend to be larger in size, because smaller developments that have stalled, they can probably find other ways to get that sorted, whether that be remain with their current lender, private investment, their own funds, things like that. So the deal sizes tend to be bigger, but I think, as I say, it's an important point to note that we are not just a development lender, and hopefully you'll see that with our products coming up shortly, that we are competitive across the board on leverage, rate, and flexibility within our products on all 4 key products there. So the key bit for you guys is obviously the rates, the products that we offer. I always like to start with the finish and exit products, because that is really our flagship products. I know Tony's not a huge fan of awards, but we'll say that we have won multiple awards for this product in innovation, because we were the first and without a shadow of a doubt the most experienced in being able to lend on part completed developments. We've been doing it from day one, so we've been lending on this type of scheme for 6 years. A lot of lenders will come in and try and lend on it, but I think it's that understanding of the risks attached to them. Quite often, I think a lot of people think if a development is stalled, then there's an issue with the client, there's an issue with the site. I think last year was testament to the fact that's not the case, and actually all the part completed development deals we've done in the last 12 to 18 months have been because of their current lenders' problems and not the site, not the client. They've been good sites, good clients, but we've seen a mixture of lenders or unfortunately lockdown, meaning that contractors couldn't get on site and the development had stalled for that reason. So I think it's certainly something that I think unfortunately for clients we will see more and more of in the coming years. And not only that, but I think we see a good mix of the current owners of the properties coming back to us to refinance, but also we're seeing experienced developers now actually going out and trying to source these part completed developments. You'll speak to a developer and say, look, I've walked past this site for months and months. Nothing's really happened. I've spoken to the guys. They've probably got in a bit over their head with it. They want to just get it off their books. It means they can buy it for a good price, make a good profit straight away, can probably get it built a lot quicker than less experienced people could, quicker and at a better price. So there's good profit margins in them for people purchasing these sites as well. So again, I think it's something to be aware of when you're speaking to developers. And I always call this product, it's a bit of a fireman's product, really. You are saving the day quite often. Every one of the clients I've ever spoken to personally on these sort of deals, they're hugely grateful for your ability to help them, because quite often they are in a really tricky position. So I think, I always look at, having been a former broker myself, a lender's job is to provide you with as many strings to your bow as possible when you're speaking to clients, that you have a resolution for whatever scenario you may come across. And I think this is a hugely unique offering for that. And where we differ to other lenders in terms of when we can step into the part completed schemes, a lot of people think it's just, it's only because there's a minimal amount of work to be done. We can step in at foundation level, well before pre-wind and watertight stage. We can step in at that level, refinance the current lender, fund the remaining build costs to date. And also, I also like to call it a bit of dual funding, because if you look at the term you can have there up to 18 months, 9 times out of 10, probably to get the build finished, 9 months, 9 to 12 is probably more than enough, because they have at least started it. They've done the initial groundworks and things like that. They may have only laid a couple of bricks, but they've started the project. So whereas a ground up development quite often will take 18 months just to get to completion level. And therefore you will have 6 to 9 months at the end of the project to actually refinance. So rather than with ground up developments, you quite often have to take the development finance, then quite often find a dev exit bridge to enable them time to sell the property, to refinance onto current lenders. I think we've all seen turnaround times have slowed across the board from that point of view. We'll have to wait and see what the impact, obviously, the stamp duty ending or the benefits of that ending on how quickly things will sell and how that will have an impact there. So, you're getting one product that covers both scenarios there, giving your client time to actually finish the build and also sell or refinance the product. So I think, as I say, that's where quite a lot of other lenders will step in, at an earlier stage. I think someone's just mentioned there how experience you need from a developer. We're actually quite flexible on both the part completed and ground up developments. We can work with experienced developers like all, but actually we're more than happy to work with less experienced. I would say if you've got someone who's never done anything, then it can be a little bit more difficult. But what we see is probably two scenarios. We see people who are working their way up through the levels of work. So someone might have done a few internal refurbs, maybe a few conversions, and are now looking into development finance and doing ground up developments. They're the sort of people, as long as they have a strong contractor working with them, more than happy to work with those. They would likely be priced slightly differently to an experienced developer, but probably only likely 25 bips different to where we would sit for an experienced developer. The other type of clients that you would probably put in the less experienced bracket would be someone who's 20, 30 years has been a contractor for clients. They've been building properties, but been doing it for clients. As much as they've got more than enough experience to do a development, there's always very different risk levels, really, of doing it for a client than doing it for yourself. So again, they're the sort of people that, again, we can more than happily work with. Again, looking at the contractors they'd be working with, or their in-house contractors that they may have on board as part of their team. And again, they're the sort of people that we can work with. As I say, maybe a slightly different parameters on the rate, but the leverage day one, loan to GDV would be exactly the same as it would be for an experienced client. And that really is one of our USPs, and certainly the development area as well. That probably leads me quite nicely onto the ground up development products, which albeit is at the other end of the slide, but I think it's quite a natural move. I mentioned, obviously, for me, there's two key USPs for us. The experience point I've just mentioned there, but also our loan size. 400,000 as a minimum loan, and that is gross loan. So that is the roll up of interest and fees as well. So you're probably looking at 330, 350 as a net loan. So we can look at those smaller schemes, which actually ties in very well with the less experienced people, because it's unlikely someone who's less experienced to jump straight in and do a huge £10 million site. They're probably going to work on a 1 or 2 unit scheme, get that done. That's then some experience on their CV, so that then they can start looking at better loans, cheaper rates, and building their portfolio as they move up the scale in terms of the size of developments they do. So for me, the two key benefits, two key USPs of our ground up development product is the 400 minimum loan, and obviously the fact that we work with less experienced clients. And I think, as you say, you can see there our ground up development rate for experienced people is 9. That is actually due to change probably in the next week to 8.75. So you would likely be looking at for an inexperienced client on a ground up development 9 to 9.25. You compare that to the alternatives for less experience, that's pricing very well. And that's where we're seeing a lot of our ground up development deals. We saw a lot of them last year, mix of experience and inexperience, because I think there was a lack of options in terms of lenders in the ground up space last year. That was probably one of the biggest areas where lenders pulled back in. So we did a lot of ground up development experience. There's a lot coming back now this year, and look, I'd openly say that there are some out there that will be cheaper than us for the really experienced, but their leverage will probably be a little bit smaller than ours. And as I say, it's more now where the less experienced people is where we're seeing a lot of our business on the ground up development product. The next product would be our residential bridging, and I think it's key to note that obviously it is residential properties that we lend on across the board, across all properties. We can look at mixed use, and that's something that we've recently come back into, but no fully commercial properties at the moment. That is something we're probably unlikely to come back into this year. I think that would probably be something to look at next year when we've had a bit more time of normal market to see the impacts on commercial properties, and from that point of view. So very much residential property, residential unregulated property that we lend on. The bridging rate, as I say, is 8%, and I think it's key to note there's a lot of marketing going on at the moment on bridging, and it often says rates starting from. We are not a rates from lender. Our rate is 8%, regardless if that's a purchase, a below market value transaction, a development exit, auction purchase, whatever it may be. It's 8%, and that's 8% regardless of the leverage. That's not get 8% sub 50% loan to value. It's 8% across the board, and I think that you then know to quote with confidence. And let's be honest, I think the vast majority of us, we don't see I only need 50%. The line of I need max is probably 9 times out of 10 what we all see at the moment. So I think that's certainly where our rate is strong. A couple of USPs of our bridging is, I mentioned below market value transactions. We can lend up to 80% of the purchase price on those, and again with the same rate. So again, there may be lenders who might offer more against the purchase price, but they're likely to change the rate for you. And I think ours works quite well for experienced clients who they don't need the leverage, but they want to spread it across multiple sites. At the same time, they know they're a good client, so they're going, well, why do I need to pay more? And that's where, again, our product will sit well. A recent change we've made to help with speed is that now, as standard, we offer no search indemnity on all bridging product on all of our bridges to help with the speed of the legal process. Because again, I think mentioned before, legal process is something that we have seen slow up a little bit just because of the volumes of business all solicitors are dealing with in the first half of this year. So again, no search indemnity can save you weeks in terms of that process. So a really important part there as well. And also, again, our loan to value, loan to GDV has been increased now as well. And we can offer a serviced option. So actually you can effectively net almost 72, 73% from us on a bridge now as well. And again, still 8%. I always leave the refurb products till last. It is called refurb, but it incorporates refurbishments and conversions. I think this is where we are, without a shadow of a doubt, the strongest in the market on both leverage and rates. I never like to say to anyone we're the cheapest or we're the best, because the market changes almost on an hourly basis at the moment. But right now, I would say we've got to be, if not top 2 on both leverage and rate across the board. So you can see 8.25 for light. Apologies, I think my laptop just locked itself, so apologies for that. So refurbishment light would be 8.25, 8.5 for medium, 8.75 for heavy. And it's really easy how our product works. it's not about, some lenders will go, if they're structural, it's automatically heavy. For us, it's about the build cost versus the purchase price or the current value. If it's sub 25%, then it will be light refurbishment. 25 to 50 is medium. And actually, we have an internal product, medium plus, which is 50 to 100, which is very similar to medium. And then anything over 100% build cost to purchase price would be classed as heavy. So it's very easy for you to quote with confidence. Right, they're purchasing for X, their build costs are Y. I know it's going to be light, medium, or heavy. And I think then moving on to the leverage that we offer, 75% net plus fees day one for a light refurbishment is as good as you're going to get on a light refurbishment product anywhere. And also, more importantly, looking at 75% loan to GDV is very strong. And again, that's almost right the way across the product, 75% net plus fees for medium, 70 for heavy, because there's always tends to be an element of development within a heavy. And therefore we have to, base that on the risk rating for ourselves. And again, very much with the loan to GDV scales down based on the level of works, therefore the higher the risk for a lender. And in terms of the term that we've offered, we've increased the term, so I'd almost call it a bit of a quasi buy-to-let product now, where you can have a good length of term for these products. If you have certain lenders that are saying that the client's got to retain it and rent it for 12 months before they'll lend on it, they must hit certain other parameters within their criteria. You've got a really good length of term there to be able to do as well. So as I say, that really is, as much as I'd say the Finished Exit is our flagship, it's a very unique offering. The refurbishment conversion is always going to be our core. That's where we always price and leverage as well as anyone else. So very much for us. And the key, I suppose, feature of all our products that we've just recently released, some of you may have seen some marketing on this, is we have a flexibility feature, which I think is going to be hugely beneficial on certainly the conversion market at the moment, where we can package the product as a refurb conversion product without planning being in place. You may have a large single house, they're going to be converting into 5 flats. It's a residential property anyway, so we can lend the day one, get them to purchase a property, have the build tranche secured. It's there, they know they've got the funds, they know that our lending parameters will never change and that they've got that funding secured. And then all that happens is planning is granted, come back to us and say, right, I've got my planning now, that build tranche is released. That can also work on enhanced planning. You can have 2 tranches. You have tranche A for your current scheme, tranche B for the enhanced planning. Tranche A is released day one. Tranche B is just waiting until the enhanced planning comes through. So saving your clients 2 applications. Most of the time they would have to go and get a bridge to purchase the property, wait till planning comes in, go through a whole new application, whole new sets of fees to then convert it onto a conversion product. So that's a huge change. I think we're seeing a lot of volumes on this side of things, because, as I'm sure you're all seeing, there's a lot of tight deadlines that vendors are setting people to buy properties, and enable them to be able to do it on one deal and still do it as quickly as a bridge, I think is ticking the boxes for a lot of clients at the moment. So that's certainly a really big change that we've made recently. So that for me is a quick overview of our products. Obviously, I'd always say Tony and his team, they know us very well. They know our products. So, please, if you've ever got any questions, any inquiries, we don't have a big criteria guide. We like to look at each deal individually, and having specialists like Tony and his team, they understand the niches, the appetite that we have. So anything like that, please give them a call, and we'd be more than happy to help. In terms of this, sorry, Tom. I was going to say, I think I run out a little bit of time. You've got a few examples.
No, you're okay, Adam. Go on. You crack on with. You've got some case studies there, which are always great for delegates to listen to, because it might just trigger something that that next client that phones tomorrow, that might be the trigger for actually, yeah, I can help that client. So you crack on with those. I could see you was coming to an end, but I could see there was 4 slides left. So you do that bit. I'll come back.
Yeah, no worries. I think it's just a few examples of really some things that we've done in the past. This is a really good example of how quickly we turned around a deal on just a bridge. Basically, a client was in quite difficulty with his current lender, so effectively it was a refinance of a current bridge. There was a slight down valuation on the products, but actually we worked with the client. And actually, this is a client, we did this one within a couple of weeks. He had the site next door. You can just see it behind it. We then did that one within 3 days, because we'd already done the due diligence on the site. We've now also funded a further 3 part completed developments for the client. and a ground up development as well for him. So I think, we like to work with the clients on multiple schemes, and once you've done one deal with us, you can see how quickly the deals can turn. But again, an overview of really the pricing at a really good leverage, and as I say, working through some difficulties there. The next one on here again is a ground up development scheme. To show you again, pricing that we did on this one was a pre-lockdown price, I would have to say, but we're certainly aiming to get back to there at some time soon. Currently we would be in terms of pricing probably about 0.729 at the moment, but sort of 0.67 is where we aim to get back to as soon as possible on the ground up products. There was again a short window to complete on this one. He pre-agreed the completion start, which is something I'm sure we're all seeing quite a lot of at the moment. Tight deadlines to be set. So again, our flexibility I mentioned before about that average turnaround time of 4 weeks, really was the key with us on this one to get it done really quickly. And again, the deal itself was demolition of the current site, construction of a new building of flats. Took us essentially 4 to 5 weeks to underwrite and complete the deal, which for a pretty tricky deal in COVID times was again, I think, a really, really good testament to the work that the underwriters and the analysts do internally to be able to work with your clients to meet deadlines. And that's something I would always say is, if you have deadlines, let ourselves know straight away. If we know what we're working towards, we can make accommodations based on that. If there's anything we can do within the legal process, I've mentioned about search indemnity on bridging and things like that. If we know what we need to achieve, we will work and accommodate accordingly on that. And I think that's a really important point to note. The next slide, again, is a conversion that we're looking at. And again, this is something I think we'll all see a lot of, and certainly a big part of our business is your PD conversion schemes. There's a lot of talk about office space and how much all of us will go back to the office, whether that be part-time, full-time, and therefore the market for those. I think we all know as well there's still a shortage of housing in the UK as well. So, these PD conversions can kind of fix potentially two problems, lack of demand for office space and also a real need for new residential housing. And as I say, I think when I look back on where we can price, something like this, for example, a decent sized scheme, 50 units in this, had the planning consent to add an additional floor as well. So again, actually looking at more of a heavy conversion product rather than light, just internal refit on that side of things as well. And again, another one where they're under tight time to complete on the site. We again worked with the clients and actually, we made quite a few accommodations on this one to make sure that we could get it through as well. And I think it's again these sort of tight timescales are something we're only going to see more and more of as we move forward this year. And the final one I think is the one I always like to spend a little bit more time on, because this is the part complete development. This is one of my own as well, not my own development, but a client that I dealt with personally. And again, I think the client was in real difficulty. It was with a large lender, a lender that we would all know, but they'd essentially said, look, we're not funding anymore. We pulled out, we stepped in, we refinanced the current lender, provided him the bill cost to the point where he'd been cash flowing the deal for probably about 4 months during the early part of lockdown. Couldn't get his contractors on site, was still paying them because they were his guys. He wanted to look after them, to the point where he came to us and said, I'm going to need to sell my truck if I have to pay my QS fee. We built that into the product, into the loan, so he didn't have to pay that as well. Working with him, and actually, importantly, this one is actually just about to come to completion of the site now. So a really good scheme just outside of Reading, of conversion of office space again into 21 flats. So again, a really good sort of example of that part complete, and how I can remember speaking to the client directly and how thankful he was, because he really was in a difficult time, in a difficult time of the year for all of us. But for him, his cash flow was really struggling. So you can come out of this as a really good, strong relationship with your clients with that sort of product.
Okay, I've just butted in there, Adam, because we've got about 40 seconds left of your slot. So just delegates, if there's any documentation you want, or just any help, obviously we've got the documentation on our hub website. Just go to that link. We can provide you with all these links. I think they're probably on the stuff we've sent you anyway, or just pick up the phone and give us a call. It's probably the best bet. Development finance is probably the one thing that I find most introducers or most broker partners struggle with the most. Because if you haven't got the experience in it, it's one of those things you really do need to have some experience in development finance to know what you're doing, know what the pitfalls are. So it can be quite a tough one at times. We haven't got any questions. So what I do, we've literally got -3 seconds now of your slot. So I'll just ask a couple, some of the pre-prepared ones. With the delays in planning applications and tighter completion deadlines, what flexibility do you have with your products?
Yeah, I think I sort of briefly covered that in the flexibility feature we have. And actually, that's an important point, that actually the delays in planning offices at the moment across the country is frustrating, to say the least. And when you've got tight deadlines and you've got to meet that flexibility of being able to do a conversion product without actually having the planning in place, I think, as I say, could be massive for clients in that market. And as I say, in a market of conversions that I think we're going to see grow massively this year.
Okay, final question then is, this is actually one I put down because I might be giving you a call later on, depending on your answer. What is the largest development you've funded by number of units?
So as far as I'm aware, in terms of a ground up development, it's actually a ground up development. I think we've done about 12 unit scheme because our max loan is a little bit smaller. It's something we're working on. So at the moment, max loan size is 3 million. We have no cap on number of units, to be honest. There's no limitation on that. I would say it's just more a factor of our maximum loan size, that we wouldn't necessarily do 50 unit schemes and things like that. But if it fits within the loan size, absolutely not a problem at all. We can look at that.
Okay, Adam, absolutely brilliant as always. Thank you very, very much. Hopefully, I've learned a couple of things today, just listen to you speak. So I'm sure the delegates have as well. We'll talk to you soon. Actually, maybe get to actually meet you finally face to face at some stage in the future, because you only took us over in COVID last year, didn't you? So we've only seen three lenders so far in our office. So come and see us soon. So, but no, thanks for that. Absolutely brilliant. Don't leave until Simon makes you an attendee rather than a presenter.
Keep my hands straight.
Just in case it all goes pear-shaped. Right, okay, so a little bit first of all, Family Building Society, we've been partnered with now for quite a while. I've got to say, really, one of the most proactive lenders that we come across, certainly during COVID. Grace was an absolute superstar for us. When sometimes we'd be contacting BDMs and it would take quite often. I'm still waiting for a call back from a BDM I rang in February on 3 cases from another lender. Grace was quite simply, you phone her, if you left a message, she'd be back within 15 minutes. And then when you gave her the scenario, she'd be back within half an hour. It was literally that great. It really was brilliant for us. So I will just go through. So there's a picture of Grace with glasses. There you go. That's Grace Bennett.
That's what you usually look like.
Everyone you receive now, obviously, because we are an approved packager with Family Building Society, one of the few that's out there. I think there's only probably about 12. We do go to some lengths to make sure the marketing material that's provided is, looks as good as possible. So this is some stuff we came up with ourselves, which is their residential and buy-to-let. I believe today, Grace, you're talking about buy-to-let. Is that correct?
I am.
Right,
yeah,
okay.
that's it. So, all about buy-to-let.
But as an added bonus, everybody, you've also got the residential product overview, which includes all of the semi-exclusive products that we've got with Family Building Society. And there is actually one other document I should send you, but I didn't want to send it with the others. It's quite a sizable document, but I'll send that. It's a picture of a punk rocker on the front and an old lady, and there's all sorts of stuff going on in this. That explains some of the stuff they'll do.
When it comes to marketing.
And some of the stuff they do is really very, very unusual. So this is one. Please listen to this this one, because there is some stuff on this that you, if you're a mortgage broker, there will be cases that you can now place that you might not have placed before if you didn't know about Family Building Society. So a little bit about Grace, first of all. Been working in financial services since 2017. Hobbies include socialising, travelling to new places, and binge watching the latest thriller series on Netflix, which, as you can imagine, takes up quite a lot of her free time, especially during COVID, I should imagine. She also loves meeting new people. Yeah, loves meeting new people, which is why she enjoys her job so much. And this is the one that always turns my stomach, her interesting fact, because I get dizzy walking down the stairs. Grace has completed a skydive over the Palm Jumeirah, I pronounced that right, in Dubai. Most amazing experience of her life. So there you go.
Hopefully
Grace,
I can go back soon.
Yeah, over to you. I'll see you in about 20 minutes.
Thanks, Tony. So yeah, as Tony introduced me, my name is Grace Bennett, and I'm the Business Development Manager for Family Building Society. That's my contact number. So if there's anything you ever want to discuss with me, give me a call and quote Specialist Finance. And what we can do, we can discuss all your options there, the products that the team have got access to as well, that being fixed rates and the exclusivity there. What I'm going to go through today, so I'll give you a bit of an introduction about Family Building Society, who we are, in case you haven't dealt with us before, not sure who we are, and then I'll go through general criteria and USPs, focusing mainly on buy-to-let lending. But as Tony said, we do some residential products as well. So it'd be great just to briefly touch base on that as well. If there are any cases that you're struggling to place, I'd definitely say give us a call. You know, it's something we might be able to consider. So if you haven't ever heard of Family Building Society, you may know us as National Counties Building Society. So we rebranded towards the end of 2016. And the main reason for the rebrand was we wanted a name that suited the type of market we were trying to approach. So we lent to first-time buyers being 18 to those applicants in their 90s. So offer, you know, a huge flexibility there in regards to your clients' ages. And, you know, being the Family Building Society, we do a lot of intergenerational lending. So trying to help those clients at all different stages in their life. In terms of us as a lender and the amount of BDMs that we have across the country, there's 6 in total, myself included. I personally look after a few postcodes within the home county. So I look after RG, HP, AL and GU. There are other BDMs across the country, as I said. So if there are, if you are dotted elsewhere, let me know and we can always put you in contact with BDM in your area. So in terms of how we perform as a lender and when it comes down to our underwriting, I think this is one of our biggest USPs because we manually underwrite. So you've actually got a human being sitting at the end of your mortgage application underwriting it, using a common sense mindset and thinking outside the box to see how we can get this to work. So I think that, especially this day and age, is really unique. Don't really find that very often. So whilst we have a policy that we go by, if something looks like a good case, something we should be lending against, send it over to me. I'll be doing all of the AIP for you. We can send it over to the team at Specialist as well and get them to submit the case. If I need to as well, I've got a close relationship with our team of underwriters. So if we need to get anything agreed, as soon as they give their approval against it, that will then support your mortgage application throughout to completion. And I'm trying to use that as much as possible because, you know, we don't want any mishaps throughout application. We want to know exactly where we stand from day one. So we're getting it approved by an underwriter. It just gives us that extra reassurance as well that the case is going to go through nice and smoothly. So as I said, yeah, we apply a common sense approach to all of our cases. We don't credit score. So what we base our cases upon is a satisfactory credit search. Now, whilst we might not be the most sort of flexible and biggest lender when it comes down to adverse, I like to think that, you know, we can take an open mind to these things. So if the clients have got the odd missed payment, the odd blip here and there on their credit report, we'll be happy to look beyond that and ignore that as long as the case itself overall meets our policy. It's only really the bigger areas of adverse that we might be a little bit more hesitant on lending against. But again, even if it falls slightly outside of policy, we may be able to get it approved by an underwriter. I think I had a case the other day where they had a CCJ on a water bill, hadn't realised it was there. I think it was about £700, but the case was really good. It's a low loan to value. The client's credit history, aside from that CCJ, was absolutely perfect. I referred it over to one of our underwriting managers, and she said she's happy to consider the case for us because the rest of it looked really good. It was something we should be lending against. So that's sort of an example there where we use that common sense mindset and that thinking outside the box to get the case fit for your clients. But in terms of incentives that we'll offer them, so we offer free valuations on property values up to $500,000, and that applies to our standard buy-to-let remortgages. Okay, so going into sort of areas of lending and then focusing on buy-to-let, standard buy-to-let is maximum 65% at the moment. I'm hoping towards the end of the year we can increase that loan to value up, but for now it is 65%. I think where one of our biggest areas of lending is the fact that we lend into retirement. So we'll give you your clients a mortgage to their 94th birthday. Our maximum age is 89 and we'll give them a 5-year term. It does work on term guidelines. So for example, a 70-year-old will offer them a 16-year term. Now, at the age of 86, they might not be in a position they want to sell that buy-to-let, or, you know, they don't want to repay the mortgage on it. So what we'll do, we can extend that term by a further 5 or 6 years. So again, offering that flexibility, whilst it's a term guideline, we will still give them those longer terms there. We have no minimum income at all when it comes down to our buy-to-let mortgages. All the underwriters want to look for is a possibility that they're able to comfortably, afford that mortgage if there was a rental void. They don't ask for any proof of this. All they state on the application is, are your clients able to cover 3 months rental void if anything was to happen? And it's just a simple tick box on a self-cert basis that they acknowledge that. I've rarely known the underwriters to ask for any evidence of that. But if they did, just maybe a pay slip or proof of pension income, or if they've got savings as well in the background for a large sum that they know if they needed to, they could easily dip into that, and that would then cover those mortgage payments. We do accept first-time landlords on the basis that they are an owner-occupier, so they only live in their main residence. If they don't, then they do ideally need to be party to the mortgage with someone that does. For example, it might be father and son. Of course, dad's an owner-occupier, but son is the first-time landlord here. I've known us to be able to consider that case in the past. What the underwriters want to look for here is that it isn't a property that then the clients can go and live into. So ideally, quite a distance away from their main residence, and that we see that they could be in the position to buy property if they wanted to themselves, but they're just not in a position to do that right now. So that's sort of what we're looking for here. We don't stress portfolio landlords at all. So we'll lend to those clients their first buy-to-let, so those are their 100. And there is no different stress tests that we're going to be applying to these clients. It's the exact same rental assessment that we apply to those portfolio landlords, those are their first buy-to-let, and also to high rate taxpayers as well. It is the exact same. And you can see there at the bottom of my slide, the rental assessments that we'll apply to your clients' mortgages. Specialists do have a 5-year fixed semi-exclusive rate with us, so I'd say take advantage of that, especially because the rental assessment that we're applying isn't the most competitive in today's market. We might need that 5-year fixed rate just to get them to the loan amount that they require. So definitely take advantage of that. It's a great product that not everyone has availability to. I haven't sort of put the property types that we accept on this slideshow, but we would look at flats. Won't look at new build flats. However, we have done them in the past. So again, using that common sense mindset, thinking outside the box to see how we can get this to work. If it's a low loan to value, we can refer it over to an underwriter. Underwriter can then give the decision if they're happy to lend on it or not. Except share freehold flats and leasehold, as long as there is 50 years remain at the end of the mortgage term, then we'll be happy to consider that property as well. Other than that, standard construction properties that we will consider lending on as well. So again, a massive area of lending for us, expats, because there are so many countries that we will accept. So as you can see there's up to 45 different countries that we'll look at on an expat basis. Those do include Australia. Now, if you logged onto our website and you're looking at the expat list, you won't see Australia marketed on there. That is because we're just not allowed to do so. But we absolutely consider Australia, and there is no other criteria that would apply to those clients living over there. We also lend to those clients in South Africa, Hong Kong, America, and then still doing Europe as well. I know a few lenders have taken Europe off their expat list. It's here to stay with us. And also the Middle East as well, we'll look at. But Tony does have access to all of the expat countries that we have on panel, so certainly give him a shout for that and he can tell you the countries that we'll look at. Same rental calculation would apply to those clients that are living in the UK to those living overseas, the expats. No changes there. And we also have no minimum income. When it comes down to our expats, we also lend to self-employed clients as well. I think that's a bit of a niche area of lending there when it comes down to expat buy-to-let mortgages. We'd certainly be happy to look at those clients. All we would ask for, if they're employed, we'll write to their employer for a reference. If they're self-employed overseas, we may write to their accountant, and that's just to satisfy our proof of address requirements. but we'll definitely have a look at that. When it comes down to foreign nationals that are living here in the UK, we will consider that as long as they've got permanent right to reside, or if they're European nationals, they'll just need to have that settled status here in the UK. Again, specialists have access to that 5-year fixed rate on an expat basis, so certainly let them know if you have an expat case in mind, we can put it on the 5-year fixed rate for your clients. To mention there as well, when it comes down to our product, we allow free of charge product transfers. We'll pay you as well for doing the product transfer with us, and it is so easy. All the clients do is you just write to us saying, I've got my broker that wants to look after my product transfer. We'll give you authority, send out the mortgage offer and the acceptance form, get your client to sign that. That secures their new rate, no extra cost, and we'll also be paying you a prop fee to do that as well. So definitely nice and easy when it comes down to product switches there. Okay, so limited company buy-to-let. We've recently actually just revised this criteria because it just wasn't as competitive as it could be in today's market. And I think a lot of people are going to be coming into doing the limited company buy-to-let a lot more rather than just having it in their personal name. So we wanted to revise our criteria, and just make it as competitive as possible. So it is only at the moment available to UK residents. So they have to be living here. We allow up to 8 directors. Again, all have to be residing here in the UK because they're all going to be going on the application form. It is 65% as it is our standard buy-to-let. If there are no personal guarantees, we'll be still happy to look at the application for them. It'll be capped at 55% loan to value. Hoping towards the end of the year we may be able to increase these loan to values that little bit higher, but for now, capped at 65% or 55% with no PGs. So when looking at the limited company itself, it doesn't have to be a brand new set up SPV. It could be one of these SPVs that's been long standing for a long time. As long as it was set up with a recognised SIC code, then we'll be happy to lend against that limited company. Ideally, we want a maximum of 3 properties to be held in the SPV, and ideally mortgaged with us or unencumbered. Now, I'm not saying that is a set rule there. We can definitely, or potentially, I should say, go outside that criteria with referral to an underwriter. Again, making sure it's a nice, good case. We'll present the case well to the underwriters and give them all the reasons why we should be lending outside of policy and under an exception for these clients. But I've definitely known us to be able to do that in the past. So I'd say if you have one in mind, speak to myself or the team at Specialist. Let's see what we can do. And again, Specialist Finance has got access to that 5-year fixed rate as well. So definitely utilise that. Okay, so our offset mortgage, we get really good responses when it comes down to our offset buy-to-let, because I think we're maybe one of 3 or 4 lenders in the market that offer an offset buy-to-let mortgage product. It's a 2-year discounted rate at the moment. Now that may change, but currently 2-year discounted rate, and it's available on interest only or repayment, which I think is great. It gives clients that huge flexibility. I think it's ideal for those portfolio landlords or those self-employed clients that know that they've got to pay a large tax bill. They put the money into the offset savings account, put it on an interest-only basis. They can offset up to 100% if they like. If they did that, they wouldn't be making any mortgage payments at all. And they've got complete access over that offset savings account. So, if they need the money urgently, it'll be in their account the following day. So I think that's a great product there. And there's no specific underwriting that goes towards this product either. It's just a product that is linked to our mortgage. So I definitely say if you've got clients that have savings lying around, especially at the moment, savings interest rates are pretty rubbish. Going to get a much better return putting it into the offset savings account there. The main option I think that everyone goes for is the payment reduction, which is when you're offsetting the interest that they're paying on their mortgage. But we do also have the option of the term reduction product as well. So how that works.
Grace is frozen on my screen. So if anyone else has got the same difficulty, or if you haven't, could you just let us know in the chat, please? Yeah, I think, Grace, if you can hear us, you've frozen, which is a great shame because you're almost at the end, actually. Yeah, everyone's saying yes. So I'm going to get this message from my IT team. Could you just quickly give Grace a call, because she's still got plenty of time within her presentation. Just give her a call, and she might need to reset or do something. I did say technical problems are the only difficulty we normally have these days. So there you go, good old internet. Maybe some more money in the meter, possibly, Grace. Yeah, everyone's got the same. She's frozen for everybody. Okay, just bear with. Everyone, just bear with us for a few seconds. We'll do what we need to do. She's just been added back as a presenter. There you go. So it looks like she's back on. This is the major advantage of having people sitting in the office next to me who actually know what they're doing when this comes to this sort of thing, because I wouldn't have a clue. There she is. Right, I'll go away. You carry on. Okay. Can't hear you, Grace. Your mic's off. That's better.
Can you hear me now?
I can hear you now, yeah. I'll disappear. You carry on. You know where you are on the slide, yeah?
Sorry about that.
That's all right. That's all right. Get better broadband. But one's all right. I'll see you in a couple of minutes.
Honestly, there's about 3 of us on it. That's why. And so sorry about that. I suppose that's working from home life, isn't it? That these things happen. But I'm not too sure where I got up to before I froze. But what I was saying is the different options that you've got for the offset product. So you've either got the payment reduction, where they're paying, they're not paying any interest for the amount of savings they put into that offset savings account, or you've got the term reduction option as well. And that will simply work by them keeping the payment as if there was nothing sitting in that offset savings account, but actually it's eating away at the term, so that their mortgage term is shorter. Is available for property purchases and remortgages, and also family members can help with this as well. So how it works is just simply there can be up to 4 savings account linked to the mortgage. Family members will hold one of those accounts, link it to the mortgage. They've got complete access over it, and only they have access to that. And so if they did withdraw out the money to it, it'll be in their account the following day. Just not as if any other family members can get that money out. So that was sort of all of the areas of buy-to-let that we offer. You know, we're a residential lender, but our buy-to-let market has grown massively, especially since we changed from national counties to family building society. So we're trying to become, you know, as flexible and competitive as possible when it comes down to our buy-to-let mortgages. So that's just a few pages there where, you know, we offer buy-to-let mortgages and how we can help. But I definitely say if you've got cases that you are struggling to place, because we use that thinking outside the box mindset and use a common sense approach to all of our cases, pick up the phone, discuss the case with me, and we see what we can do. But then just to give you an idea of the other areas lending that we cover on a residential basis. So as I said previously, the terms that we offer in lending to retirement is a big area of lending for us. This is where we see most of our business come from. And we'll go to age 95 on a repayment basis. Or as I said before, 94 on interest only, with term guidelines. When it comes down to our mortgages into retirement, you know, we'll be flexible. We won't just look at state and private pensions. We'll look at large pension pots. We'll look at stocks and shares ISAs. What we're seeing a lot of at the moment actually is these limited company directors who have built up a well-established business, but have got a management structure in place, meaning they can take a step back at any time. As long as that can be confirmed by an accountant, that's an additional income that we use for them as well. We'll also take a look at rental income, and we use 100% of that to support the mortgage into retirement. When looking at our interest-only mortgages, I like to think that we're really flexible. You know, we don't have any criteria that should limit your client's options. So with downsizing, we say it's maximum 70% loan to value, and within that 30% remaining equity, they're able to comfortably downsize. So we have no minimum income, we've got no minimum amount of equity that needs to be provided, or a minimum property value. All the underwriters look for is a possibility of them being able to comfortably downsize within a 5-mile radius, and all they do is go onto Zoopla or Rightmove and just ensure that that is a possibility for them. They just put in the property postcode, filter it to 5 miles, and put the remaining equity in there. And as long as they see listed properties, they'll find that offers a repayment strategy. Now, there are other strategies that we will look at, up to 75%. But again, if we've still sort of only got the option of using downsizing, we could put 5% on a repayment basis and do it on a part and get that to work there. Joint borrower self-employed is something we see a lot of. And the reason why we're so niche when it comes down to this area of lending is because we take the parents to age 95. You know, you're not capped at 70, 75 with some lenders. We will take them to 95 as we would with our standard mortgages, and that to be supported with their retirement income. Now, that is on a repayment basis. We can look at joint borrower self-employed on an interest-only basis as well. And how that would work, it just caps it to age 70. So if parents are 65 or younger, then we'll take them to age 70 there on an interest-only basis, which I think is great as well. Because, you know, it's a big commitment these children are taking out. And the ideal scenario would be that 5-10 years down the line, they'll be in a much better position to be able to take over that mortgage themselves. Putting on interest only is keeping their payments low while they're used to making that commitment. We do have a 95% family mortgage product, similar to the Barclays Springboard mortgage, in where we ask for additional security. But rather than just asking for that security and savings, we also accept a charge on the family member's main residence. And there's also an offset product available as well, which will allow the clients to reduce their monthly mortgage payments. But also when looking at the affordability as well, it reduces that element. We offer expat residential, same countries, and we treat them exactly as we would here in the UK. We do require them to have a UK mortgage and a UK bank account, but we'll definitely look at those clients as well with those foreign currency income. And then lastly, we've also got an offset residential product as well. This is available on repayment only, but you know, you've got the same flexibility where they can offset up to 100%. Family members can also hold one as well. So if they did want to do that, they've got complete access over it, money will be in the account the next day if they ever needed to do that. So yeah, so that's all the information there. So if you have any news cases to discuss, they're the best numbers for you to call. Alternatively, you can call me directly and just quote Specialist Hub, and then what we'll be able to do is discuss the case. I'll deal with the AIP for you. We can send it over to the team at Specialist and get them to package and submit the case for us there.
Grace, it's absolutely brilliant as always. Thank you so much. Don't worry about the little break in the. Don't worry about it.
Typical.
We had a speaker last month. She had to go away from where she was sitting 3 times because her dog was barking at the postman.
No.
So it happens. But you can't help broadband. You can. Well, you can't really help a dog barking as well, I suppose. But anyway, okay. So we've not got any questions from delegates. So I'm just going to ask a couple. How long have we got here? We've got a couple of minutes before the break. Just to mention, actually, that you mentioned about expats. That's actually within the brochure that we sent over today. And hopefully, I'm allowed to do this. I have actually included Australia because we did complete that Australia one. Sort of like last month.
Do.
But I did actually put available through packages only because it wasn't on your website. I thought maybe it was a packager exclusive one for Australia. So I might, if I need to take that out, let me know. But yeah, all the current lenders are on there. We are looking to obviously check that as often as we can, but there might always be situations where either one's come off or another one's gone on and we've not seen it because obviously the marketing department
certainly let you know as well if there are any changes.
Yeah, the family run site marketing department doesn't phone me when they add another sort of like lender to the expat list, like the expat country list. So it's something we check out as often as we can, but. If you've got one, obviously you've got one where
any for a while.
Yeah, if you've got one where a client lives in Iraq or Syria or Yemen or something like that, then it's safe to say it's going to be difficult to place. But if it's one that doesn't appear on that list, but you think it probably should be, give us a call. It's probably the best bet.
Yeah, definitely.
I was just going to ask one thing. What is the maximum number of buy-to-let properties you will accept from one particular client? I know for limited companies it's initially 3, but for non-limited company borrowers, how many would you accept for one client?
Do you mean for us to mortgage?
Yeah, so if you had a client, we put a client to you that, for example, had 3 properties they're looking to refinance, would you do 3 or would you do 6 or is there a cap?
We've always said ideally 2 initially and then possibly a third in 6 months' time. Now, I'd say that is quite vague because if you've got someone that's got 3 or 4 that they want to mortgage, you know, with me being the BDM, we do have that bit more flexibility, and we can refer it to the underwriter will be able to consider that for us. So I'd say 2, but we could potentially look at more than that.
Okay, the questions you set yourself, you've actually already answered one, which is about maximum age. The other question you put was, what do you need to support the application for portfolio landlords?
So portfolio landlords, so we would treat someone as a portfolio landlord who's got more than 4 properties. Now, if that is the case, we just want to see details of the properties that they own. If they've got a portfolio schedule that themselves, they're happy to send over, we would accept that. Alternatively, we do have a form that they can complete to put the list of properties there.
Okay.
So
no more questions. Grace, thank you very, very much. We're about a minute over time, but that's only because we lost you for a minute. So well done on keeping it bang on time, as always. Absolutely brilliant. So as Grace said, any family stuff, family insight stuff you've got, they do appear on sourcing systems. We're just negotiating at the moment with the sourcing systems to go on there. So we will appear under specialists. So, but if you see they come up on somebody else, give us a call, because our marketing's better and we pay you on the day of completion as well. So there you go. That's a reason to use us straight away. Right. So what we're going to do, Grace, thank you. Okay. So this is Kerry Bradley from United Trust Bank. Everybody, you should have received these by email from us this morning, which is, Kerry, just remind me, are you speaking about second charges or residential mortgages today?
I'm going to obviously both, really, because obviously our criteria fits both products.
Good. Luckily, I've sent both, so that's the good news, everybody. So a little bit about Kerry first of all. Experienced BDM, working at UTB since 2019. Kerry's role is to work with specialist mortgage brokers. Her area is the South, and she can help brokers by providing residential mortgages and second charge loans for a wide range of purposes, from purchasing property, remortgaging, or to raise capital from their property for a variety of purposes. She really enjoys spending time with us. Is he still 7? Oh, because I'm not sure when this was written. 7-year-old son, socialising with family and friends, and a puppy called Maybell, which is keeping all the family busy. I always love this bit. A good night in will be watching a crime drama on one of the Real Housewives shows, which my wife is probably watching one of those right at this moment, nursing the hangover that she got from being down the pub last night, which is a guilty pleasure with a G&T or a glass of Prosecco. Just a complete aside, I did get a phone call at midnight last night from one of our neighbours who was very concerned about her husband, who she got in and he wasn't responding to her, and he had a heart attack 3 years ago, and she was really concerned, about to call an ambulance. I've run down there only to find that he drunk a bottle of gin whilst watching the football and was just completely, he was not quite unconscious, but he was, so I did all the tests and he was absolutely fine. But there you go. Don't drink whilst watching England is what I recommend, to be quite honest with you, because it's not a good thing. It really isn't. It's not good for your nerves. And he was in an absolute state. He's 67 years old as well. So Kerry's interesting fact: Kerry is a keen upcycler of furniture and enjoys cooking. Me too. I've got my cookbook available in all good bookshops fairly soon. She's also a Spurs fan. And as a teenager, many years ago, she became one of the first Girl Scouts in London to be accepted. I wasn't allowed in the Scouts because I kept losing me woggle when I was in the Cubs. So I was kicked out, unfortunately.
My son's actually become a Cub recently, so I'm quite proud. So he's following in his mum's footsteps.
They only wanted me in. I jumped the queue because I was quite decent at football when I was a kid, so I was allowed in. But then when it got to, he wouldn't allow me in the Scouts because I was just a bit of a pest, unfortunately. So, but anyway, right, over to you, Kerry. You've got 27 odd minutes plus questions, so I'll see you very shortly.
Thank you very much. Well, thank you, Tony, and nice to meet everybody, even though it's all virtual. So hopefully I will keep you entertained in my presentation. What I will do is I'm going to talk through the presentation, and then obviously we'll keep the questions to the end. So let's begin. So we're just going to skip through now. You've already obviously met me from Tony and presented me, so I won't bore you too much. But what I'd like to do is just talk about the where we sit today with regards to the background of United Trust Bank. So surprisingly enough, we actually started lending back in 1955. So the bank itself was established on development finance. and retail deposits. And then throughout the decades, as you can see, it was only until 2010 we actually diversified and launched into bridging finance. Then in 2011 we launched into asset finance lending, which is actually broker driven business. So if you do have any asset finance questions or any asset finance business, please feel free to speak to specialists, because they will obviously refer it to me and I'll get in contact with the asset finance BDM. But in regards to asset finance, that we lend against agricultural equipment, fleet, cars, buses, and so forth. So it has quite a diversified opportunity there. It wasn't until 2015 the bank itself launched into the second charge lending arena, and that's where we've sort of built ourselves from where we are today. So 2019 saw us launch into the first charge market. 2020 was quite an establishing year for us. Obviously, COVID aside, I'm very proud to say that within the midst of the pandemic, we as a lender did not stop lending. We kept the doors open for new applications. In fact, we were helping other lenders' clients refinance. We were helping clients that had unfortunately been declined by other lenders take on those types of properties for them. We also accepted retypes of valuations, even for valuers that weren't on our panel. So we worked really hard to ensure that we supported the broker and the client market out there in the midst of the pandemic. Off the back of that, we were able to launch new products. So I'm pleased to say that we've now launched a first-time buyer product. We have an interest-only product within the first charge lending range alongside our standard purchase remortgage. We also have an unencumbered product available for clients that may have paid off their mortgage years ago and want to refinance now, clients that maybe have inherited a property that want to refinance it to release capital for home renovations. So there's quite a lot of diversified products within the product range. We lend up to the age of 85, and we actually lend up to 85% loan to value across the first and second charge product range. So there's a lot of diversification on who, why, and what we can lend against. We have sort of 4 areas that I'm going to talk about within the presentation, which is the people, the types of property we lend against, the products, USPs, and then obviously I'll give you a brief overview of our process. One of the things that I would like to say that obviously we've been working with specialist finance for many years, and I've certainly worked with them for many years through different lenders. So any case inquiries that you do have, anything that you feel might be pertinent or slightly unusual, give specialists a call. They will check our policies for you. They work with us quite closely and they do know our policies quite well. They'll be able to assist you with any inquiries that you do have. Just moving on to the next slide. I'm just going to talk about the types of people we lend to. So let me start with the employed. Now we have quite a lot of diverse entities or sort of clients entities that they may have. So we deal with clients that are on 0 contract hours. We deal with clients that are bank workers. We can take clients that have multiple jobs. In fact, our system itself allows up to 6 different income streams within the portal. So again, you could have somebody that may have 2 jobs and maybe receiving child benefits or maintenance payment within that. They're able to add that in. So we can take quite a large amount of different income streams. With employed, we also have quite a flexible policy. So all we ask is that the clients are either employed in their current role for 3 months with no probation, but they must have a continuous 12-month employment history, or they can be in their current role for 6 months and not necessarily have that 12-month employment history. But again, they must not be in probation at that time of application. We also accept self-employed applicants, and that can cover sole traders, partnerships, limited company directors, and contractors. Now, within this self-employed, we ask that the sole traders and limited company directors are self-employed for a minimum of 2 years, and we work off the latest year's figures, not an average of, which is great. So we can work up to the most up-to-date. We also accept self-employed as long as they have been submitting SA 302s for a minimum of 2 years. And with limited company directors, we will accept again trading for 2 years with an accountant's reference to verify, along with 1 month's bank statement to confirm obviously credits going into their business account. We can also accept contractors. Now, contractors need to be trading only for 12 months, and we'll accept either limited company directors or clients submitting through umbrella companies, or if they're just doing standard SA 302. So there is some flexibility there. One thing I will stress in regards to self-employed directors and director contractors is that they have to be taking a salary or dividends drawn. So with regards to That's the income stream. So unlike sole traders, we can use retained profits. With self-employed directors of limited companies, we must use salary and dividends drawn. So moving on to additional income, and again, this is quite another USP. So in addition to those income streams, we can also take into account pension income, both private and state. So again, we get a lot of applicants that may be employed that have come out of retirement, or they've taken early retirement. So as long as we can evidence the pension income, and again, that's provable by the annual pension statement and credits of the pension going into a bank account, we can use that. We can also take benefits, which are working tax credits, child benefits and family tax credits, so that we can use them. And we can also take maintenance as well, but it must be court ordered or CSI arranged. Someone just asked a question regarding contractors. So with zero contractors, the question being, how long do they need to be in the current role? We would need 18 months continuous evidence for a zero contractor, and that gives us enough time to calculate for the sustainability side of the income. So as long as they've been contracting for 18 months on zero contracts, we can accept that. Where we're dealing with bank workers, and that tends to be NHS staff, we can be a bit more flexible in regards to the time frames. So again, always let us know or send the case in on referral, and we can make a decision for you. And that's what makes us slightly flexible within the marketplace. We're able to have that flexibility. So we're not a standard bank that has a black and white lending criteria. And this is one of the reasons, hopefully, you'd be looking to come to us on that basis. Someone's just asked a question on the chat regarding furlough. Currently, we're not accepting anybody that's in a furlough scheme, whether it be full-time furlough or part-time. However, we do have flexibility on how long they can be returned to work. So all we ask for is 1 month back to their normal working conditions, with confirmation by one pay slip and a telephone call or a email from an employer confirming they are back to work would be sufficient for us. If you're not quite sure regarding what income we can use, as long as there's evidence to support an income stream and we can get comfortable with it, I'm pretty much confident to say that we can take quite a lot of sources. So again, if you're not quite sure, just please give us a call. We do have a help desk available to answer any questions. Just moving on to the next line. Now, this is my favourite in regards to property. As you can see, I don't put too much detail on the presentation, because the good news is we do have a USP sheet and we do have the product guide. So hopefully, which obviously Tony mentions is sent out to you. So hopefully there isn't going to be too much that you may not be aware of. But this is probably the biggest USP for us at the bank, and my favourite. And the reason for that, it shows the flexibility of the types of security we can lend against. So obviously, as you can see on there, it says we can include concrete, steel framed, high rise, ex-council. But just going into a bit more depth about that, we'll also look at graded buildings, barn conversions, properties that may have large acreages attached to them. So ex-working farms, for example, now can turn into a main residential we can accept. I've just actually agreed a case where the property is a converted windmill with an adjacent cottage attached to it. So we've got a family and grandparents moving into that, which we've agreed to do. I've also agreed to do a flat above a wine bar last week as well. And this week I've just agreed to do a property that has a small studio workshop attached to it as well. So we can look at certain semi-commercial properties. Our biggest area of lending is flats above shops. So for example, we do a lot of lending. We don't restrict what the commercial element is below. As long as we're lending against the lease and not the freehold with the commercial element, we can lend. So we do many flats above and masonettes above, retail units, so news agents, grocery stores. I've mentioned a wine bar, so we can look at properties that sell alcohol. That can include pubs. I haven't lent on a club yet, so that might be on referral. We can lend against flats that may be above a takeaway, Chinese, Indian, or a restaurant. So again, we're more than happy to accept those types of securities. And the key thing for us to allow us to do that is because we work with a specialist panel of valuers that are aware of our specialist lending criteria. So again, the key thing for us, as long as the value that we panel work with can confirm the property is habitable, the property is mortgageable, it makes sense to us. Someone's just asked a really good question here regarding the different construction types. Are our rates loaded for that basis? No, they are not. And this is one of the reasons I would always strongly suggest look at our products before you go elsewhere. And the reason for that is typically if you're borrowing up to say 60% loan to value on an ex-local authority flat above a shop, we can go as low as 3.85 or 3.8 on the first charge. So again, the rates aren't as double digits. We're not a specialist lender that loads the rates because of the property types. The bank's decision to lend is because we want to lend and obviously diversify within the marketplace. We also don't cap the loan to value. So for example, in theory, for what we deem as a prime customer, we can go up to 85% loan to value on a flat above a Chinese takeaway, and we won't load the rate. Well, the rate will go up because of the loan to value going up. However, the rate isn't loaded because of construction. So we will lend that same loan to value if it's a lovely house on a street in a built up residential area. It's exactly the same. And the good thing is as well, we don't load the arrangement fees. So like most specialist lenders out there, they sometimes, well, most of them will charge a percentage of the net loan amount as the arrangement fee. We don't. So we have a standard flat fee structure. So again, non-standard constructions, PLC, timber framed, high rise. We have no restrictions on the number of floors within the block. However, we do have a concern of external cladding, like any lender would be. So as long as we know the on the ESW report comes back as A1s and A2s, they're more acceptable to us. But again, there is no loading of rates because of those assets. So again, the flexibility, and there's no loading on the arrangement fee. So just as an example, you could do a second charge on a high rise ex-local authority flat, and it will charge, if there is what we call zero status clients, they're only going to pay a 795 lenders arrangement fee to us. So again, it's very, very cost effective by utilising our product range. All the rates and the products are in the flyers that you were given earlier. If you do need any additional product information, please don't hesitate to ask. Someone just asked, would you lend on a shop and a flat on one deed? Can you lend on the flat value as a resi or a buy-to-let product? So we don't actually offer buy-to-let products. However, we can lend on, we have done semi-commercial, but we're very restrictive on the type of, if it's on one title, we're very hesitant depending on the retail unit it is, because we're not a commercial lender. As I've mentioned earlier, we can lend on leaseholds above commercial, but we're very reluctant to lend on a trading business asset, or that could be privately leased out, just in case we can take possession, because we're not really into commercial lending. But again, it can be reviewed on a case-by-case basis. If it happens to be a small workshop, or the client actually has a studio or an office attached, that is something we can certainly consider for you. So just moving on, I'm just conscious of time, and I do have a habit of talking quite a lot. I'm just going to run through very briefly, obviously, the USPs in regards to what we do. So the key USPs for us, as I've mentioned, is that the property types is huge. Another key thing for us is the fact we don't work off a credit score. So again, unlike most banks, we work off a credit score rating. We look at the client profile and how they've conducted themselves within the last 12 months. And we do this by looking at Equifax, and we establish where they sit. So we have what we call 3 status definitions, 0, 1, and 2. A 0 status customer to us is somebody that has all their current unsecured credit up to date. Now, we mean up to date, i.e. they could have been 2 or 3 payments down on a credit card a month ago, but they've brought them up to date. So it's now technically showing as 0, or they can show it satisfied through a confirmation from that creditor. If they can prove that they're all up to date, we will ignore those missed payments a month ago or 2 months ago. So you could have somebody that's got 3 or 4 unsecured creditors where they're 2 or 3 payments down, but they've got them back into a good situation. As long as they're now showing 0 or back to that situation, we can ignore those missed payments. With regards to properties and that, in regards to their mortgage, as long as they haven't missed a mortgage payment in the last 12 months and don't have any CCJs or defaults registered in the last 2 years, and we have a bit of criteria behind that, I'll explain that in a moment, we will treat them as prime customers. So again, for what is not deemed to be prime to the high street, we will pick up those customers and deem them as 0 status prime. Just moving on to CCJs and defaults, we will ignore any communications and mail order defaults, regardless of the size. So you could have somebody that's got a mail order default for £1,000 registered 6 months ago. We will ignore that for the plans. So you could have somebody that's had that, but their credit profile is perfect elsewhere, but another lender will not take them on. We'll take them on as prime. You could have another scenario where a client has had 5 or 6 CCJs and defaults registered over 2 years ago, as long as the balance is less than £5,000, they will go straight onto our prime plans. So again, there's flexibility. We'll also look at clients that are in a DMP plan or that have had a DMP plan recently, or come out of one. So again, there's some criteria that's separate to this that we can look into, but typically we want them to be out of the DMP plan, or if they're in a DMP plan and they want to do a debt console, we can certainly help that with the loan purpose. So again, there's a lot of flexibility in regards to how we view and profile customers. And we can also accept customers that have had up to 2 missed mortgage payments in the last 12 months and could still be 2 down, and they're maybe doing a refinance away from that lender to redeem the situation, or they're due to do it for a debt consolidation. So that moves us nicely into the loan purpose and the reasons why you'd be doing a first or second charge. Now, we have an unlimited scope on rationale of what is acceptable loan purpose. We can go up to the full loan to value to lend somebody doing a first remortgage or a second charge for a tax bill. As you can imagine, we get a lot of sole traders doing second charges against their main residence because they haven't set enough funding aside to pay the tax man. We don't have a limit on the monetary value of a tax bill payment, and we work with the HMR officer dealing with your client's case, and we will pay HMRC directly on behalf of the customer. So I actually completed on a case last week where we did a 236,000 second charge for a tax purpose, solely for tax purpose. We also do quite a lot of debt consolidation. So most of what we do is either for home improvements or debt consol, but it can be a combination of the two. So we do a lot of, as the DMP payments off, we do a lot of people paying off CCJs and defaults. We do a lot of debt consol, and it could be multiple debt consols. I think the highest we've ever done was somebody where we paid 32 creditors. Needless to say, our underwriters aren't too keen on those types of underwriting cases. However, if you're prepared to put the work in on the debt consolidation part, we're more than prepared to underwrite and get those cases across the line for you. One of our other areas is obviously onward purchases that we do for loan purposes. So things like if clients want to do a refinance or a second charge to an onward purchase of a buy-to-let, an investment property, they're buying at auction, they want to buy a second home, they want to buy abroad, they want to do a buy-to-let, whatever the reason for the onward purchase, again, we can facilitate that with our loan purpose. We also do a lot of loan purposes, as I've mentioned, for the onward purchase, for the debt consol. So again, there's pretty much nothing we wouldn't consider for the loan purpose for. Anything that sort of where the clients are purchasing a car, we do have to restrict the term because it has to make sense financially in regards to sort of purchasing onward cars. But other than that, we are very, very flexible. Now, just moving on swiftly, I'm just conscious I've still got 5 slides and I've been chatting away. Case studies. Now, this normally pops out, but it's not actually quite working today. So just to give you an overview of some case studies that we have done, and I've mentioned them already throughout the presentation, home improvements is a good one. So this particular case, I think we lent 75% loan to value on a remortgage for a non-standard steel framed property. The clients themselves couldn't get finance because they were actually 2 payments down on unsecured credit. So we were able to do a refinance and allow them to do a debt consolidation alongside the home improvements as well. So again, the flexibility of what we can do alongside the product range is quite vast. So we don't always just look at sort of, segmenting the products themselves. So it gives you that opportunity to see the scope of what we can do. Another one of the case studies on here is raising a deposit. Now that was a second charge. It was 63% loan to value, borrowing £100,000, and that was for the clients to do an onward buy-to-let purchase. So again, the scope of the loan purposes of what we can do is very, very vast. I keep repeating that, don't I? As you can see, I'm quite passionate about obviously what we can do for you. Just moving on with regards to obviously how you need to work with this. So obviously we work with specialists. So anything you need in regards to documentation, you go straight to the lenders. The specialist hub for lenders. You are able to have a decision in principle. So one of the key things that we've done recently is enhanced our technology. So within the last month and a half, 2 months, we've created a DIP process now. So we have a full integrated portal giving DIP decisions based on first and second charge lending. The DIP decision now creates a bespoke checklist regarding your customer on that particular product. So from a submission perspective, you now have a specific checklist needed for that client. We've also integrated an AVM system within the portal now. So when you run a dip, it will create an AVM check in the background, which we don't actually, there's no charge to you or your client. It will run the AVM and it will come back and say whether a full val, drive-by or no valuation is now required. And then it gives you the submission checklist. So we also have document upload, which we've implemented now into the portal. So we have a really integrated system now that offers you loan calculators, affordability checks, dip and document upload with online submission. We also have a mortgages help desk and a mortgages inquiries inbox. So if you do have any quirky cases, ideally in the first instance, we would say speak to specialists. But if you do want to run anything by us, please do so. We are obviously available to help. I'm going to wrap up now because I'm just conscious of time. Thank you so much for your attention. I appreciate your time, and I'll hand back over to Tony for questions.
Thank you so much, Kerry. That was absolutely brilliant. You were speaking at 110 miles an hour. Which,
I know, I'm so sorry.
That's all right. No, your passion comes across. Believe me, it really does. So as Kerry mentioned, if there's anything you need, again, just on our website, the Specialist Hub website, just go to the lenders section. You can download anything. It also gives, for every lender we deal with, it gives, or we're trying to get every lender we deal with, it's just a little bit of their history and what they will do, which I find is quite important sometimes, what their niches are, what their specialities are. But of course, it's then just somewhere where you can get all the information in one location. So if there's any documentation you need, it's all in one location. Or of course, just pick up the phone or email us and we do what we need to do. You've answered the questions pretty much. I believe. So thank you to Atul and to Nadir for asking questions first of all. Bobby asked a question and you've then gone back and said, yes, okay, you've already answered that. Fine. So thank you, Bobby, as well. Right, how long have we got? We've got 5 minutes before we kick off. So here's some questions you set yourself, Kerry. So here's your test. So what technology has UTB launched in the last year?
Right, so not many people are aware of this, but we actually were one of the first banks to launch biometric identification. So we now have what we call Chat Hub. Now, Chat Hub allows not only for clients that, and again, in the midst of the pandemic was great because for ILA requirements, or witnessing anything from a solicitor's perspective, that's eliminated quite a lot of needs to see a solicitor, especially if we can't do identity checks for customers. So again, as long as a client has a photo identification, driving license or passport, we send them a link to the Chat Hub they can download, and then they can take a picture of their face and it scans it against the biometric ID and it verifies them of who they are. It's the same technology that's actually at Heathrow Airport when you go in with your microchipped passports. I'm not very techy, as you can tell, but it's a very, very good system. Also, as well, we've launched, so we've got that now off the back of the Chat Hub. We also launched online speaks, which means that previously when we were doing final checks for funds release, we were having to do a checklist of questions on the telephone to a customer. What we've now done is created that within the Chat Hub system. So again, the clients can do it on or offline. It's an immediate feedback and it allows us to complete cases a lot quicker. We've also launched the dip process. So we've integrated the portal now. So we've got live dip, we've got document upload. So there's many more enhancements coming, but we've actually done quite a lot of technology. So to make the journey working with us a lot smoother.
Okay, Nadir has asked a question which I can answer. What do the rates look like? Where do I find the product rates at different LTVs? I've just checked your website but could not get any info. Nadir, just check what I sent you by email this morning. That has both the first and second charge product guides, which has all the rates, all basically not all the criteria, obviously, because that goes into there's another document goes into a lot more depth. But that's with you. So if you haven't got it, check your spam. If you still haven't received it, let me know and I'll resend it to you. How long we got?
We're like a specialist club, you see. We don't advertise everything on the website. You have to have access via our portal. So you need to be registered directly or you need to go via specialists. So because we don't have a whole of market distribution at the moment.
I'm glad you mentioned the two-word specialist club. So watch this space, everybody, for something that's coming out in the near future. But I won't say too much at the moment because my staff will probably kill me. But yeah, just watch out for what's coming in the future. We've got about a minute or so. So I'll just ask one more. Someone's actually typing, so we might try and get 2 questions in. Do you charge any upfront fees?
No, we don't. So the only fees chargeable would be if we did a full internal valuation or had to do a drive-by, and the product fee. So again, the product fee can be added up to the loan, or the client can pay it before we go to offer. So there's no holding fees, there's no upfront fees. As I said, the client can either add the valuation fee as well to the loan, or they can pay the valuer directly. So again, there's flexibility around that. And sometimes clients want to pay upfront because it works better on the affordability. So again, just stressing that fees don't need to be added, especially if you're adding fees and then all of a sudden the case fails affordability. Take the fees off and let the clients pay them directly beforehand, because sometimes that can make and break a case.
Okay. Kerry, thanks ever so much, as always. Absolutely brilliant. Thanks for getting through so much in such a short space of time. So you've done brilliantly. Okay, stay on just while Simon takes you off as a presenter, and I'll speak to you soon. No, come and see us soon, because we haven't seen you since you had short hair, basically. So
about 18 months now, I think.
Yeah, it is. Yeah, come and see us. Our next speaker is Sally Precious-Ward from Together. Absolutely delighted their return to the market. And there's Sally, who, as you'll see in a moment, started just prior to lockdown with Together after working in various roles in the industry. We've still not met. We've done loads of Zoom meetings over the last year, but we've still not met face to face. So probably fairly soon, I would say, we'll actually get to meet Sally. Okay, so first of all, everyone, you should have received, Sally's talking about commercial term mortgages from Together today. So you should have received this via email today. As you can see, as always, it's got our branding on, our contact details, and also all the products and other bits and pieces. Okay, so first of all, a little bit about Sally. Sally has undertaken a number of roles in the industry, including IFA, mortgage broker, business development manager, and corporate relationship manager. The benefit of 22 years financial services experience and having worked for Bradford and Bingley, there's a name from the past, during the previous credit crunch, who ended up nationalised, certainly helped when Sally joined Together on the 2nd of March 2020, only to find that 3 weeks later we were in the midst of a pandemic. Absolutely, yeah. Well, I feel your pain, I really do. Interesting fact, this isn't for me either. Like Grace earlier on, who likes skydiving, I don't like doing this either, by the way. When not visiting brokers, she's an advocate for the benefits of cold water therapy. And now with lockdown easing and being able to go out and do face-to-face visits again, she regularly seeks out wild swimming spots when travelling the south of England with work. Sally, just so you're aware, we're very close to the Grand Union Canal. So if you fancy a dip in that, be my guest.
I have done a broker meeting back, where one of the first ones face-to-face back, and they said, we've talked about cold water therapy, and he said, can we go and do some sea swimming as part of it? So I was like, absolutely, let's have an outdoor meeting, and that's what we did. They had a business meeting on the beach and then a swim afterwards. Not all brokers are as keen to have a meeting in that format. Majority are still selecting office, I have to say.
Okay, when you come and see us, if you want to go and jump in the canal, I'll bring along a chair and sit on the side, and we can.
Okay, spectator only.
But yeah, you will not find me jumping in cold water. Really won't. Unless it's a jacuzzi, I'm not going anywhere near it.
It's not cold anymore, Tony. It's the warm weather now. So
still too cold. Right, Sally, over to you. I'll see you in about 20 minutes.
Thank you very much, Tony. Yeah, thank you very much for the introduction, and thank you all for joining on the call today. Tony's given me the last session slot, so I'm not sure if I'm actually his least favourite BDM in the area, and he's given me the graveyard shift, or whether or not I'm his favourite, and he thinks that I can bring an A game with entertainment for you all with my presentation today. I have been sitting in the background actually listening to others, so I appreciate that your brains may be slightly fried now with all the information that you've being given about what we all do. It is really important, but what I will say is that you've got specialist financial services as well as me as a point of contact at Together. So I'm not expecting that you're going to remember everything from what I tell you today, but just to give you a flavour about commercial term and our proposition. So I'm going to start off and just tell you a little bit about Together. So we have been lending since I was born, 46 years. A loan book of over 4 billion, and we've got about 500 plus colleagues. Now, you're probably thinking to yourself, you've just told me that you're going to bring your A game of entertainment value to this presentation, and I've started off with 3 dull facts. That does not bode very well. But there is a reason why I want to give you that piece of information. Specialist lending is quite a new norm for many lenders, but it's not for Together. It's always been our norm. We're a good sized lender. We're very experienced in the specialist market, and that is why I do share that information with you. A lot of our branding that you see will say that we've got a common sense approach to lending, and this is absolutely a key point for us. It's something a theme that will go throughout the presentation today as I'm chatting along on there. Very flexible lending criteria. And as I say, I'm going to specifically talk to you about our commercial term proposition today, but just for your own information, we also lend in the auction market, bridging market, buy-to-let, residential first charge, residential second charge, development finance. We have a whole broad product range available to you. So this is my all-time favourite slide for Together. I've only been with the company a short time, but I can talk about this slide for forever, really. I'll try not to do that, obviously, because I'm sure you're all busting to get off for your lunch at 12:30. But Together are not your average mortgage lender. And so what this slide does really is it just gives you a complete analogy about our flexible approach to everything. So we don't do an average purchase. We don't look at average credits. We don't look at an average property. We don't look at an average income. And what do I mean by all of those things? So these things, purchase, credit, income, property, they underpin our entire product range at Together, but they're very, very valid when I talk to you about commercial term. So I'll start with not your average purchase. So we lend to limited companies, we lend to individuals, we lend to SPVs. We will also lend, though, to SASs, to SIPs, to trusts, to offshore companies. All we need in that kind of instance is a copy of the trust document to make sure that we are lending within the terms of that. We then also allow gifted deposits and gifted equity for purchase, and that is also relevant for commercial term. Gifted equity or gifted deposit just needs to come from a close family member. And I'll give you for example of that, of a case that I've seen recently, was a hairdressing salon owned by mum, was handing it really down to the daughter, £100,000 purchase price, but mum was going to gift £50,000 worth of the equity. So that wasn't an issue for us. We just take the £50,000 as the gifted deposit and lent the other £50,000 to the daughter. Not your average credit. So when I talk to you about credit, Together are perhaps wrongly known as being an adverse credit lender in the market. We do some adverse lending, but adverse is probably about 10-15% of the business that we lend. It's a really small amount. But our approach to credit policy is quite flexible. So we ignore anything that is over 12 months old. So any defaults, any CCJs, any mortgage arrears, if it's more than 12 months old, we are not going to take that into account for credit purposes. We also ignore anything that is under £300, so your communication phone bill, blip, something like that. And then we also ignore any CCJ or default that is satisfied up to the value of £3,000. And it's only when you go outside of that criteria that we start to apply a demerit scoring process. So if you have got a client that wants to do a commercial term mortgage and they've got a default in the last 12 months, that would count for us as one demerit, and we interest rate load the interest rate accordingly, but 1% per demerit. And we go up to 2 demerits. We're not keen on anything above 2 demerits unless there's a real plausible explanation behind it. Not your average income, and this is probably a really important one for you to take into account for commercial term. So every affordability calculation that we do for the purposes of lending is done on an affordability basis. There are no gross income multiples with Together. So you always need to be aware of your client's net income, and that can be net income from multiple sources. It can be net income from employment. It can be net income from benefits. It can be net income from pension. It can be net income from a limited company. And you may have a client that's given you a net profit figure from a limited company, but they've also taken drawings before that net profit figure has been given. We can also take then the net drawings that they've taken plus the net profit figure. And what you need to really bear in mind as I go through this is adding together all your clients' net income sources and then having a total net income figure, because that is the figure that you're going to use for the purposes of calculating on these loans. And then finally, not your average property. Together are really well known for this. We lend on all sorts of property. There's a bit of a running joke internally at head office. If it's got a title, it's got a value. We're not quite as flexible as that. But whereas the government have got this saying, a hands, face, space, we've got something similar that we use, which is teach, preach, gamble. And they are the things that we don't like. So we do not like lending to schools. We do not like places of active worship, and we do not like casinos. Anything outside of that criteria, it's pretty likely that Together are going to be the one that will lend on that particular security for you. So when you think about commercial term, there's lots of lenders in this market, but you maybe start to mention something like a farm or a factory, and then they're less interested in that kind of security. That's absolutely kind of security that Altogether we'll look at. And the other thing to mention on this slide is that your client can be a combination of all of these things. Your client can have not the average credit, the client can have this income from different income streams, and they can be buying an unusual property type, and it will all still fit within our criteria. So reasons really then that we write commercial business, and this is good to go through about how we differ from the rest of the market. So the high street provider does not tend to like a trading business. They prefer a commercial investment property. So Together can lend on a commercial investment property, which is where the client is buying a commercial premises, which is then going to be leased to somebody else. Treat that a bit like a buy-to-let property. What is the income that lease generates? And then we'll lend on that commercial basis. And Together can absolutely do that. But Together will also lend on a commercial trading business as well. So where a client wants to buy or maybe refinance some premises that they are trading from or want to trade from moving forward. Another reason that the high street lender doesn't like commercial business is that that particular business has not been trading for long enough. Together don't have a minimum term for the amount of time that a business must have been trading. It's a big plus for Together, so we can also lend to new businesses. And if I refer to the previous slide when I'm talking about not your average income, a really important thing to remember on that is that we only need your clients to be self-employed for 1 year, and we can take projections, but we can also take, for commercial term businesses, projected income as the sole source of income for the purposes of lending if that client is buying a new business. Now, I don't want to present on what we can't do, but I'm just going to give you 3 scenarios because I think it helps to bring these kind of things to life. So if we look at somebody who's looking, for example, at buying a cafe cake shop, something like that. Example 1 could be that your client is working in an established cafe and the owner of that cafe wants to sell, so your client wants to buy that. What you'll be able to provide to us will be that the cafe will have some trading accounts in place and that the client understands that business. So this is the kind of rationale behind the case. Whilst the client is starting up a new business, there is actually trading accounts to show how that business will run. And it is reasonable to expect that that client will continue to run that business and the income will continue to be generated by that customer base that's already in place. What we would therefore ask for on that basis is an accountant's reference. And what the accountant's reference is going to do is the accountant is going to collate all the information together, provide us with it on one document, and we anticipate that the accountant then does that piece of work. So the accountant has looked at the historical trading accounts for that business. He has looked at the plausibility of that client continuing to run that business in that format. And he has also provided, I say he, that's very awful of me, he or she, the accountant, has then also provided us with the projection of the income for that business that she anticipates that client is going to earn moving forward. And we are going to look at the projected income for that business and use 90% in that scenario. Example 2 could be a client is managing a cafe already, sees another trading cafe already up for sale that they want to buy. And this would work similarly to the case that is in example 1, that it is realistic to expect that the client has some experience in that particular arena, will move forward to that trading business and be able to continue to earn the income from that. An example with a startup business that I am going to give you where we wouldn't be able to lend, though, would be if you've got a client who wants to start up a brand new cafe business and buy some new premises for that to trade from. There wouldn't be any experience, there wouldn't be an existing customer base, there wouldn't be any trading accounts in place for that business on that particular scenario. So because there wouldn't be a strong rationale behind that case, we wouldn't be able to lend in that instance. I hope that makes sense to you all. Happy to go over these at the end when you've got some questions. Third one then, high street provider doesn't like a particular property type. I did mention this already, farms, agricultural land, factories, garages, lockups, land, hotels. There's so many types of security that Together will lend on, whereas it will be discounted by many other lenders in the marketplace. We only have a minimum loan size of 50,000, so that is quite competitive from a minimum loan size perspective. We don't have any location restrictions, so we will lend in Scotland. We don't require a business to be city or town centre. It could be a barber shop on a back street, and that will be acceptable to Together as well. We are not concerned with business entity, so lenders can get fussy about certain types of businesses, and barbershop is a great example of that. Pawnbrokers, fast food shops, and we don't restrict lending to particular types of businesses. The only thing that I would say to consider with regards to a business entity is that we do consider a reputational risk if it is a particular type of business. And then finally, speed and internal payout transactions for us. So as I say, you've got specialist financial services who have access to Together's products. They package up a case for us, so we receive it fully packaged. Commercial term, our turnaround time is 72 hours from receipt of that fully packaged application to get that through to solicitors. If you were doing a refinance and the loan was under £200,000, then we can do an internal payout transaction. So Together are very well known in the marketplace for being able to offer speed on service as well. So commercial term criteria. I'm covering these off. I'm not expecting you to be making notes and remembering everything on there. And there is a slide later on that shows you our product guides and how you can use them for a refresher of this information that I'm giving you today. But just some basics on our commercial criteria. So it has to be on a first legal charge only. We can't do a second charge on a commercial property. We'll lend on commercial properties, semi-commercial properties, and we can lend one loan against multiple securities if your client wants to have it structured in that particular way. There's no minimum income requirements from a client. So if they're doing a commercial investment property, we don't have minimum personal income requirements they need to have in place. Income can be validated via an accountant certificate, which I've covered off in the previous slide. We don't want, as a lender, we don't want to see accounts, we don't want to see bank statements, we don't want to see business plans. The accountant's reference is going to be a document that will become your best friend when submitting the business to Together. The accountant will have reviewed all that information for us and collated it on this single accountant certificate that they provide to us. So the accountant will have reviewed previous trading figures, projections. What we also want on an accountant certificate is a plausible explanation. So for instance, if there was an uplift in income, there may have been an impact of the pandemic on that client's income. So the accountant certificate may show an income level of, say, £30,000 for 2 years ago, £15,000 for the most recent tax year, and then the projection for this tax year could be £30,000 or above moving forward. As long as we understand and the accountant has put some rationale behind that and can explain how a business was impacted during the pandemic, we will revert, as I say, and we can then look at using the projected income figure as long as that is plausible to us. I've talked about the setting up a new cake shop and some new examples. I'll give you a case example of something that I've actually done this week with a client. And this is a client that's currently working in a bank, and they are looking to buy a post office and village shop that is up for sale. So again, what there is there's the evidence of income for that particular business, as in the trading accounts that are already in place. The existing staff are going to stay in place in that business, so it is plausible and reasonable to anticipate that income level is going to continue. The client works in a bank, so she's got experience in a role that makes it plausible that she can go into this business from day one and take it over. Now, because she's giving up her role in the bank, we can't use any of that income because it's not going to be there moving forward. But we have used the accountant certificate, which has provided us with that very information. What was the income 2 years ago? What was the from the trading accounts? What were the trading accounts income from 1 year ago? And then a projection for this client for the forthcoming tax year. We lend on commercial terms to first-time buyers. We don't have any previous experience requirements for them. We lend to foreign nationals and expats. That's more used for commercial investment property. And then we've got adverse profiles, which I covered on the very early slide, that your client can have some adverse credit sitting in the background. It's more than 12 months ago, so we don't consider them adverse from our credit perspective. They may have some adverse within the last 12 months. And then, as I say, we'd interest rate load by 1% per demerit on that basis. So commercial investment versus commercial trading and how we treat this. So I'll talk to you first about a commercial investment property. So we would treat this as if it were a a buy-to-let property, really. And this is an actual live example of a case that we've seen. It was somebody that was buying a retail unit below with a flat above. Retail unit below had £750 income on the lease, and the flat above was £450 a month rental income evidenced by way of an AST. So we had a purchase at 200,000, a loan required at 65% loan to value, which is our maximum LTV on commercial term. So a loan requirement of 130,000 with this rental income of £1,200. £1,200 divided by 120%, because that is the ICR that we're going to use on pay rate, then gave us a residual rental income of £1,000, multiplied that by the 12 months and divided it by the pay rate of 7.99. Based on the rental income from that property, actually gave a borrowing capacity of 150,000, 187, but it was actually just restricted by the loan requirement of the loan to value requirement of 65% loan to value. So in that instance, straightforward lending, self-funding commercial investment property for us. And then the other alternative then that Together see lots of is commercial trading. And we've got quite a unique calculation for this. So I will talk you through it and then I'll show you an example on the next slide. Is that we have total secured debt to income. Now, if I go back to a really early slide when I'm talking about clients having net income from all different sources, the reason you need this total net income figure is because that is what you're going to use for the purposes of this affordability calculation. What you're going to have alongside that is the client's total secured debt repayments. So they may have a main residence in the background. There might be some other commercial premises that they own. Caveat on that, if your client has got buy-to-let properties and the income that you are using on the accountant's reference is net income from land and property, you do not need to incorporate those buy-to-let mortgages in that income calculation, because we're using the net income from land and property. We assume that they've already been taken into account. So when you've got those two figures, you've got the client's total secured debt and you've got the client's total net income figure, you need to add into the total secured debt the cost of the new Together loan that your client is looking to take out. And then as long as the total secured debt figure is no more than 50% of the client's total net income, that is a straightforward affordability pass for Together. Now, we can go higher than 50% TSDI ratio with a referral. 50% is without referral. If it's any higher than that, we want a referral and a rationale. And I will talk you through a calculation on the next slide just to bring this to light for you and how we would consider that. So straightforward calculation on this one. It was a limited company case where the limited company had got a net profit of £60,000. And the director was also taking drawings from that business of £15,000. So we got the total net income figure of £75,000. That gave a net monthly income of £6,250. They had an existing residential mortgage in place, which was £1,650 per month. And then the new loan they were looking at taking out with Together, £150,000 at 7.99. So that was going to cost just shy of £1,000 a month. So their total secured debt repayments in that instance, £2,649. So that is an absolute straightforward pass for Together because it's under 50% loan to value. Using this same calculation, if we had a case, say Mr. and Mrs., so this is Mr's income that is on there, and Mrs. was working as a vet, for example, an employed vet, but she wanted to go and set up her own veterinary practice. So her personal income was going to cease. We wouldn't be able to use the future income if she's going to set up a new practice because there wouldn't be any evidence of that income being in place, a client base or anything like that to be able to evidence that was plausible. But if I ran through the same calculation to say the client's total net income £6,250 per month and the main residential mortgage is the same, but the new loan was going to be £325,000, which would give you a mortgage payment of £2,163. That would give you total secured debt repayments of £3,813 against that £6,250. Now, that as a ratio would be 61%. So on the face of it, that looks like it's above 50% and unacceptable. But actually, in that case, we would suggest that that would be a reasonable case to submit to Together, because if the client is going forward to set up a veterinary practice, whilst we haven't got any income that we can use for the purposes of affordability, it is realistic that that client is going to generate an income from that business, which will then top up the net income that has been used in this calculation. And that in turn would reduce down that TSDI ratio to somewhere more in the region of 50%, which would be acceptable. So when you get our product guides, this is what they this is what it would look like for commercial term. So a lot of the things that I've covered today, as I say, I'm not expecting you to remember everything. And the first page of the product guide that you get for commercial term will have this information on there. So it talks you through a bit about the criteria, the types of customer we'll lend to, how we're going to work out this affordability calculation, how we look at credit profiling for that case. And then you'll have the following page, which then talks to you about the rate on there. So you can see on there, standard rate 7.99% without any demerits, and it's loaded up accordingly for that. What I will say on this particular product, and with all of Together's unregulated product range, there is an element of flex on there. So where the product guide does state that our minimum loan is 50,000 and the maximum before referral is 250,000, that literally just means that if you've got a case up to 250, you can submit it without needing to speak to anybody. But we're seeing commercial term deals go through significantly higher lending amounts than 250,000. So certainly don't be off-put by that when you see it on that particular guide. There is Tony's information. I thought you've sprung me there, Tony. I was like, this is going to be my contact details, but it's not, of course. It's no, Tony's contact details.
I took them out. So you're basically, yeah. Hi, everyone. I'm back. Yeah. Just basically, if your documentation needs, same as the previous three speakers as well, just go to our site. It's got everything there you need. We've sent you the terms this morning, exactly what Sally went through in the previous two slides. So everything's there. Of course, just pick up the phone and speak to one of my people. Yeah. And they can run you through whatever you need to run through. We're just absolutely delighted that Together are back.
Yeah, I think it's worth me commenting. We're delighted to have you back as well, Tony. But it's worth me commenting. So when Together, we changed our distribution model at the back end of last year. So we own Accept Business via a panel of packages. We're delighted that Tony and the team are on board as this panel of packages for us. So you've got, for lots of reasons, you've got an area of expertise for your case inquiries that you can speak to them about. But then any cases that come through specialists, they give us absolutely high quality packs. So when I talk about our speed and our fast and efficient turnaround times in processing, that can only be done by the fact that Tony and the team provide us with the highest quality of packaged applications, which they absolutely do. So do utilise that to your full capacity.
I will stress it's the team, it's not Tony that does the packs. So yeah, because I haven't packaged a case in I don't know how long, but any questions? We got one question from Atul, which is your criteria for franchise. I think that means if someone was buying a property and was also purchasing a franchise, I presume that's what the question is. How would that be seen? Because they're not buying an existing business as such; they're actually buying into a franchise.
Into a franchise. Okay, so we only lend on a bricks and mortar valuation on a commercial property anyway. So it will depend on that. We won't lend for the cost of purchasing a particular franchise business. We would be lending for them to purchase a commercial security in order to trade that franchise from. Okay,
but if it's a new, so they're buying basically they're starting up a new business as such. So I presume it's something like a Domino's Pizza.
Yeah.
And all they need is the finance to purchase the actual premises themselves.
Yeah.
Would that be? I mean, that'd be looked on favourably. I would have thought, but
the issue when you've got that, if you with the cafe example that I was giving earlier on, is that if you've got a trading premises, so if they were buying a franchise that was already trading, then you've got a set of trading accounts that we can support, because we're going to use projections for the purposes of affordability on that. We can use projections, but we can only use them where they're backed up with evidence from that. So the issue with, if you're buying a Domino's Pizza, for example, the issue with that is what can you provide to show that if it's a brand new franchise, that it is going to generate that same level of business, because you're going to be reliant on a different franchise trading accounts. But if you were buying that identical premises in that franchise, then we could lend against that identical premises. But if we were looking for the purposes of income, we would need to substantiate that with that identical business source being there as a source of income.
Okay. We've no more questions from delegates, so here's the ones you set yourself earlier. So, will you lend on agricultural land? I think you've already answered that.
Yeah,
but,
yes, we will. Yeah.
Absolutely. That was that one. Can you lend on commercial property when the client intends to reside in it too?
Yes, we can. There is a calculation, and it depends then whether it falls in regulated or unregulated territory. So if it is both and the client intends to reside in that, the qualifying criteria for us is the client going to be resident in 40% or more of the overall security? So if the client is going to be resident in more than 40% of the overall security, it then forms a regulated mortgage contract. It would fall into regulated territory, have a different affordability calculation, and be based on that rather than the commercial term per se that I'm talking to you about. If the client's going to reside in less than 40% of it, so I think of ones I've seen recently, guest house is a prime example, where 15-bedroom guest house, the client's going to reside in something like 10-20% of it overall, that would still go on a commercial term basis.
Excellent. Okay. Sally, thank you very much. You're bang on time as well. Absolutely great today. All the speakers have been bang on time. So thank you so much.
No problem. It's lovely
to have together back. And sorely missed in the marketplace for a good few months last year.
Yeah.
But absolutely delighted they're back. And keep them coming. We've got two examples coming up in what I'm about to cover of what Together have done for us. One was about 3-4 years ago, and the other one was 2 weeks ago. Just to give you an idea. But Sally, thank you.